Hello everybody, it's Chuck Carnevale, co-founder of FastGraph, the Fundamentals Analyzer software tool, and of course one of the founding partners here, the Dividend Kings. And this is my continuing series of subscriber requests where we've had Dividend Kings subscribers request to have me personally cover certain stocks. And today I'm going to be taking a look at AbbVie, and I do want to offer for a disclosure, I am quite long the stock, and I'm quite content that I am long. Now I do believe it's a very undervalued stock, as I'll show you here in a moment. And there are some issues, there are some risks, as there always is when you're investing in stocks, that I covered in the written portion. But now I'm going to kind of go through a dynamic FastGraphs Friday Analyze Out Loud video utilizing the FastGraph tool to kind of show you what I see in the company and why I like it. So let's start out by just looking at the company. Let's look at the business behind the stock, if you will. And I'm going to start out with adjusted operating earnings here and point out a couple of things. Number one is since Abbott Labs spun AbbVie off, the company has had really a very excellent record of historical operating earnings growth. You can see their growth rate has averaged over 15%. Therefore, the PE ratio I'm drawing here is a PE of 15. The blue line, by the way, is a normal PE, which I'll bring in when I bring price into the equation. But I also want you to focus on their dividend line. They started out with a relatively low dividend, but then they increased it dramatically in the first year, and then they've had steady increases in the dividend all along. Now, one of the theses that I adhere to is that fundamentals matter more than stock price. And in the long run, stock price will go where the fundamentals go. So just from the perspective of earnings here, let's start out with looking at AbbVie's price relative to their fundamentals. Now, I think the stock was originally, when I originally can measure it here, it had a PE of 10. That was in December of 2002. And then, within a matter of a few months, it started trading at this 15, we'll call it 14 to 15 PE range. And it kind of tracked that. There was a little period where it got slightly overvalued, where the PE did balloon to 20. And then, of course, it tracked that 15 PE. The PE did get up again close to 20, over 19. And then we had, things like the opioid epidemic and so on. And we've had a lot of pressure on a lot of healthcare stocks, not just AbbVie. A lot of stocks in the biotech and the pharmaceutical sector are also very undervalued, all resulting in that. But anyway, what's happened is we've gone through an extended period of time. It's lasted over 2 years here, or almost 2 years, I should say, where the stock price has been trading at very low valuations. Now, in the meantime, the dividend has continued a steady ascent, and I think that's very important. But I want to make a very strong point here. If I looked at the S&P 500, I would be able to show you a very overvalued market. So I do consider the market at large overvalued. But AbbVie is very undervalued. I would put, as I mentioned in the written portion, I would put the value of AbbVie by year end at somewhere in the mid-150s. Okay, and you can buy all you want now for about 85. The company has a blended adjusted earnings yield of 11.67%. That's almost twice my minimum requirement. The dividend yield is sitting right at 5.49, or almost 5.5% if you bought it today. The company is B plus rated, but it does have a lot of debt, and I talked about that quite a bit in the written portion, and we'll talk about it a little bit more here in this video. But what I'm seeing is a stock that ought to be trading up here at 15 times earnings, that's trading down here at only about 8.6 times earnings, 8.57, which gives us a tremendous opportunity. If I just calculated the rate of return, if these earnings estimates, notice the light green shaded area is talking about earnings estimate, if this company was to grow at these rates, and the stock did trade at a normalized PE of somewhere between 14 and 15, we would have an annualized rate of return for the next couple of years at over 50%. If I measured this just at the lower valuation, the blue line, we'd have a rate of return over 45%. Now I want to go to the forecasting calculator a moment, and I want to stick with this 8.9. Even if it traded at this 8 point, we'll call it 9. The PE line I have here is 9. If it traded only at a 9 PE and actually made these earnings accomplishments, you'd still average over 27%. So I consider this stock extremely attractive, very undervalued, and I'm going to talk about dividend safety here in a moment. But let's look at performance for a moment. Despite the fact that the company is so undervalued, if I compared its performance since 2013 when it went public, basically, where it was spun off, with the S&P 500, I want to point something out. These are very strong numbers for the S&P 500. Yet if I look at AbbVie and the rewards that shareholders got, even considering the stock being undervalued, they generated more capital appreciation than the S&P did, 12.7% annualized versus 11.2. 10,000 turned to 25,000 versus $22,700. But the dividend advantage, and I'm really investing in this for the yield with what I'll call the capital appreciation kicker, and that is I've got $6,000 in cumulative dividends for every $10,000 invested, or over 60% of my money back, if you will, versus only $2,200, almost $2,300 had I invested in the S&P. So this stock has been a great performer. Most of that is attributed to the 15% growth rate that the company has achieved. Now going forward, and I only like to go out a couple of years or so, we've got a very strong growth rate expected for the next couple of years. Now, the Humira is eventually going to weaken. That's their flagship drug. There are only 8 analysts that are giving me a forecast out here for 2023. But the number, they do look for a 6% negative number. But for the next 2.5, 3 years, I believe AbbVie is going to have some very strong growth. So, let's go ahead and look at it now from a couple other perspectives. Let's look at operating cash flow. This is a high-yielding dividend-paying stock. And I do want to look at it just from a standpoint of the cash flow covering the dividend. So it's also inexpensive on a price to cash flow basis. But what I really want you to see is that the operating cash flows are significantly higher than the dividend itself. So they've got a lot of support for their dividend from a standpoint of cash flows. I can also look at free cash flow, which to me is the acid test. It's the money that's left over after what the company had to spend to run their business. Now, I don't have any estimates on free cash flow, but again, I'm seeing free cash flow. The worst case was free cash flow covered the dividend in 2014 by, just a small margin. They had $1.82 per share of free cash flow and they paid $1.75 dividend. But then free cash flow since has been significantly covering the dividend. So when I look at this stock from, a lot of other metrics, including things like EBITDA, what I see here is a stock that I consider very undervalued on almost any fundamental cash flow or earnings-oriented metric that you would want to look at. I think this company has tremendous opportunity, at least over the intermediate term, as I talked about. And I also covered pretty much the pipeline of drugs in the written portion. I also talked about the efficacy of some of the drugs that are going to basically be replacing Humira, et cetera. But then I also went into fund graphs or financial underlying numbers, and I showed you several aspects of debt to equity and so on that I'll kind of revisit some of those here. But one thing I wanted to first look at was the fact that the company has been reducing shares. Now they went from $1,630,000,000 to $1,600,000,000 to $1,550,000,000 to $1,488,000,000. Now, if I shorten this time frame and just look at how they've reduced share count, it's actually been relatively benign. It's been about 2.5%, 1.5 to 2.5% over the last several years. But what I like about that, I like to see a company buying back their stock when their stock is cheap. And my thesis is, if I'm not willing to invest in the company, I don't want to see the company investing in themselves either. I don't want to see the company buying their stock back when it's high. I think that destroys shareholder capital. But if they're buying the stock back when it's inexpensive and seeing the same thing I am, like AbbVie has been doing, then I consider share buybacks a very, very strong positive. Now, I also want to take a look at some other very important aspects here. Again, I already talked about cash flows, but I want to take a look at the cash flow statement again, and I want to look at free cash flow, as I pointed out. Now, the company does have a lot of debt. I pointed that out. So let's go ahead and look at total debt, first of all, and then long-term debt. And a couple of things about this that I think are important. The majority of the company's debt is long-term. I think that's critical. That's important to understand. In other words, they've got plenty of cash flow to amortize that debt. And they've even got levered free cash flow, that's going to easily cover any of the short-term obligations that are coming up. And another thing that's very important is the company has been reducing their debt, and they're committed to reducing their debt going forward. I think that's also an important consideration. Now, initially, they did take on excessive debt from the standpoint that the company, and I'm looking at quarterly data here now, so these are quarters, not annual. When they bought the Allergan acquisition, they obviously took on some debt to do that. But then as I reported our last financial statement, they've begun to pay that debt back. So I consider that a very strong positive. I also pointed out to you that their average weighted cost of capital is about 4.4%. I don't have that on fund graphs, although we'll be adding it at the first of the year. But what I do want you to see is their return on invested capital was over 19%. And it's actually been rising over the last couple of years. Now, it was much higher in the past, but the company has obviously been making some moves, some very important moves in my opinion, to kind of shore up their balance sheet, reduce their debt, their cash, they did have a bunch of cash before they made the Allergan, but they're starting to build cash back up again. So, I think the company has a very strong balance sheet despite the debt they have for the reasons I've already suggested. So all in all, when you come right down to it, I think this is a very high quality company. I think, debt might be the biggest risk and of course the potential loss of Humira sales. But Humira is a very sticky product. I do believe it's going to be very hard for it to be totally, I don't see its sales going completely away, but I do see them shrinking. But I also see drugs in the pipeline. There's always a risk of pipeline drugs. So all in all, when I measure it, I think all the risk that's associated with this stock is already priced into the stock. That's one thing I like about it. I don't see a lot of downside. And I would also mention this. If I go into my custom calculator here and I put in a growth rate of, I'm just going to put 1% so that I have a number. If I have just a 1% growth rate, in other words, if I have no growth going forward, I still believe this stock would be very, very inexpensive, because even a company that doesn't grow, and utility stocks are a good example of that, is worth a reasonable multiple of the earnings. And I think, a 7 or 8 times multiple is way too low for this company. So even if Humira causes them not to grow, I don't think there's hardly any risk of them not being able to at least maintain revenues. Now, whether they can grow it or not, the forecast, the long-term growth forecast is almost 6%, but there are only 3 analysts making that. I can go into other sites like Yahoo and look at Yahoo estimates and check other groups, and Reuters group of analysts following the stock think earnings growth is long-term 3 to 5 years is going to be over 8%. So they're actually more optimistic than what I've got here with Reuters. So, if I went into my custom calculator and changed this to, and I'll just keep it simple and change this to a 8% growth rate, if you will, then, you can see that there's a tremendous long-term opportunity in AbbVie. Ceteris paribus, all things being equal. If they're able to continue to grow EBITDA, continue to grow cash flows, continue to grow earnings, and as a result, continue to increase their dividend. I do want you to note that their dividend has grown at a very, very high rate, but I want to shorten this for you because I want to go to more realistic rates. Dividend, even over the last couple of years, they've been raising the dividend by double-digit rates, and in 2018, they actually raised it by 50%. So, they have a good historical record, very inexpensive stock, high-quality company. I believe it's really worth taking a look at and doing your own research and digging a little deeper. I hope my article helped. Again, for disclosure, I'm long AbbVie. Anyway, if you like this, you might also want to subscribe to my YouTube channel. I would appreciate it, and we also very much appreciate you being Dividend King subscribers. So I look forward to talking to you next week when I bring you my second of 4 companies that I'll be covering based on subscriber requests. Thank you for watching.